So in modern economies, they are mostly run by fiat money. Fiat is Latin for let it be done. So fiat money is not backed by gold, and it's not pegged. So the UK is running a fiat currency, as is in the US and lots of other countries as well. So fiat money is how you run modern economies. The gold standard ceased in 1971. So if you go into the bank, you will not get gold for your money.
Simple idea that I was involved in creating in 2008, we realized that there was an economic crisis, there was an employment crisis, there was a green crisis, there was a biodiversity crisis, there was a fuel crisis because we knew that oil was beginning to decline. We knew that we needed to transition to a sustainable economy. So what we proposed was a large investment program in sustainability. Things like making sure that our houses are insulated, making sure that we have new energy generation schemes and new energy transmission schemes and sustainable transport based upon electricity and not oil, and on and on and on. Now, could the government of Scotland do that if the Scottish Growth Commission's whole idea, the Sustainable Growth Commission's ideas were in place? No. Why not? Because they have said that the Scottish government must not borrow because it's got to reduce its deficit. The whole basis on which the Green New Deal would have to take place would be on the basis of upfront borrowing to fund the investment to get this process of change taking place. That's the way in which all processes of change are funded. But it couldn't do that because of the deficit rules. So therefore, Scotland will be left behind the green curve, one of the lagging states in the world, instead of being one of those states at the forefront. And this would be catastrophic for Scotland, because Scotland has got all the ability to be in the lead in this race by the fact it's got more sustainable energy capacity than virtually any other country in Europe. It's got more tidal capacity than any other country whatsoever in Europe. And it could, therefore, be investing heavily to be in the lead of this whole race to become green.
How much you can make in an economy, in your job, for a given amount of time. So if you worked on a production line, how many widgets per hour can you make? And you can imagine if you're on that production line, you can improve your productivity through more automation or better processes. You can make more widgets per hour. Where it's a bit more difficult is in economies that are largely service-driven, like the Scottish economy is now, and like the UK economy more broadly is. So if you think about a service such as cutting someone's hair, what does it mean to improve productivity in that sector? You might think about cutting more sets of hair per hour, but how could you do that? You could be a more skilled barber or hairdresser, but it's not a job that can be easily automated to a sense. Imagine the same problem in things like care or other service sectors. So this idea of productivity, boosting your economy through more efficient or more effective processes, very important, good to study, not easy in some sectors as others.
Every government has to have. What it means is how they use their spending to influence behavior in their economy, so what they choose literally to spend their money on, and how they choose to tax that money back. In other words, who they tax, how they tax, and of course what they therefore penalise and what they incentivise as a result. So fiscal policy refers to a government spending and revenue cycle. A fiscal deficit rule, which is what the Sustainable Growth Commission is proposing, basically says that the government should not spend more than 3% more than it can claim back from the economy in tax. Now, it is said that Scotland has not done this for the last few years, although, let's be clear, the Scottish Government has actually balanced its budget in every year because that is what it is required to do. And so whether or not there's really a deficit in Scotland or not at present is not known, because the data we've got in the GERS, the Government Expenditure and Revenue Statement for Scotland, doesn't actually answer that question in a way that is reliable. But can you reduce that deficit, which is said to be 5.9% at present, to 3%, which is what the Growth Commission says, and not pursue austerity? Well, the only other way it could do that is to go for hyper growth. In other words, boost the economy enormously. And the only way it could boost the economy enormously, given the current state of the Scottish economy and the world economy with COVID and Brexit and everything else, is by government spending. But government spending is ruled out by what is being proposed because the government can't borrow under the fiscal rule that the Growth Commission is proposing. So there's only one other option left if the two figures of spending and revenue are brought within 3% of each other, and that is austerity, which is the very thing that the Growth Commission says it rejects.
What's coming in and what's going out of the country. And it's divided into two elements. There's what's called the current account, which is exports and imports. Basically, that's your trade side of things. So imports and exports might be goods, but they're more likely in the UK to be services. So nothing crosses the border, but if an architect completes a contract for a company in Germany, then they receive a payment for the service provided. So there's sort of intellectual goods being exported, but nothing actual physical. And then you have what's called the capital account, and the capital account is things like inward investment, outgoing investment. If we bought shares abroad or something like that, that is an outflow on the capital account. The capital account would also include things like repatriation of profits, dividends, interest charges, rents, things like that, going in or out of the country. So
monetary policy tries to control inflation in a different way from fiscal policy. Both fundamentally look at the balance within the economy. The focus of monetary policy is controlling inflation. And the only tool that is really available to control it in a normal situation is the interest rate. Interest rates are set by a central bank. And so Scotland would have to have its own central bank if it was to have an effective monetary policy to control inflation. But under the Scottish Growth Commission proposals, there will be no effective central bank in Scotland for some years to come, because Scotland will be using the pound sterling, which is English, under these proposals. And therefore, interest rates set in England would be what would be used to control the inflation rate in Scotland, which would not be relevant. I mean, literally, Scotland might have a very different inflation rate. I don't imagine it would greatly, but it's theoretically possible. And Scotland would have no mechanism under monetary policy available to do that. There's one other part of monetary policy that I need to mention, and that is quantitative easing. Now, QE is a separate topic, but basically it is the process of the central bank injecting money into the economy when there is a situation where it's short of the cash to make the literally world go round. And if you haven't got a central bank with its own currency, which is what the Scottish Growth Commission proposes, quantitative easing, which has made sure that the UK banks and the UK economy has been solvent for the last 11 or 12 years, would not be available to Scotland after independence, therefore completely, absolutely destroying the possibility of the Scottish government intervening to ensure that there would be stability, growth and security within the Scottish economy post-independence. The last thing that the people of Scotland, of course, would want.
The central bank's really very simple. It's the bank for the bankers, Royal Bank of Scotland or something like that. They have what's called a reserve account at the central bank, and that holds the money that that is actually belonging to the bank as opposed to the customers of the bank. And if I instruct the Royal Bank to make a payment to somebody who banks with Barclays, if I instruct them to pay £100 to the Barclays customer, that £100 comes off my account. It also comes off the reserve account of the Royal Bank, and it goes onto the Barclays reserve account, and they then put it into the internal account of the customer. So the payment system is going through the Bank of England, and it transfers the money from between the commercial banks through their reserve accounts. It's also the bank to the government. So the Treasury's accounts are held at the central bank. And therefore, when the Treasury, pays somebody's pension, that is a payment from the central bank to the pensioner. When you pay your tax bill, that is a payment from you that goes to the HMRC account at the central bank. But more than just that, the central bank is also, it's the source of all of the money in the economy, because it's the central bank that creates the money. and it does that by simply crediting an account. So it can deposit money into the Treasury account, which the Treasury can spend, which they've been doing during the COVID crisis. It can deposit money into a commercial bank account, which the commercial bank can then lend out or spend or do as they wish. So if a commercial bank gets into trouble and there's a run on the bank, as happened with Nationwide, then they can go and ask the Bank of England, the central bank, for an emergency loan, in which case the central bank simply deposits whatever is necessary into the reserve account. There's no limit to how much money the central bank can pay into any of its accounts. It's just a computer entry in an accounting ledger, doesn't come from anywhere. The central bank is only a central bank if it has a currency. So in the Growth Commission plan, the problem is that they talk about having a central bank, but they also say that we wouldn't have a currency. So in that case, the central bank isn't really a central bank. It's no different from any commercial bank. It would be under exactly the same constraints because it can't just create sterling. So it's not a lender of last resort because it doesn't have anything that it can lend. So it's a sort of, it could, at that sort of level, it could only really be a pretend central bank.
Let me explain what quantitative easing is. QE, as it's called, is the process where a central bank with its own currency creates new money by making a loan between the government and the central bank. Now, this is done very simply by tapping some entries into a keyboard. All money is a promise to pay. And all that QE is the government saying to its central bank, please create new money, which we promise to repay to you, but actually we don't say when. And of course, because they own the central bank, they don't have to say when they'll repay it. And in practice, they never will. That QE money is then injected into the economy. It's injected into the economy by way of buying back the debt that the government creates to fund its deficit, because most countries have governments that run deficits. And in that way, QE funds a government's deficit and has meant there's been no demand in most countries in the world upon bond markets to fund the ongoing deficits that countries have run to manage the global financial crisis of 2008 and literally almost everything that has happened during the COVID crisis. So QE is effectively about the government funding itself through its own central bank by, in effect, running an overdraft. Although, let me be clear, the Bank of England completely deny that. They say it's about controlling inflation, and bluntly, nobody really believes them.
Because the government debt, which is made up of bonds of various sorts, is actually the national savings of the citizens and companies and pension funds and so forth in the UK. So if you have a premium bond, that's your savings, but it's the government's debt. Why would you want a foreign country to take away part of the savings of the country? It's a very strange idea once you realise that. There's other things to do with the national debt in that it's actually much smaller than the BBC, for example, talk about. If you read the news recently, you'll see people saying because of COVID that the national debt has gone up to something like 2.2 trillion. Well, it hasn't, because 900 billion has been bought or provided by the Bank of England. So the actual national debt is about 1.25 trillion pounds. As in the last year, the national debt has actually gone down, not up. And that's because the Bank of England belongs to the Treasury. It's a subsidiary of the Treasury. You can't owe yourself money. So the 900 billion that the bank has provided effectively has cancelled that debt. Even if you do treat the national debt as a debt, then over the last 30 or 40 years, because of oil revenues accruing to London, Scotland has actually paid in something like between 300 and 400 billion of surplus revenues. So if you took the national debt at 1.2 trillion and said we're due 8%, so maybe 100 billion, we've already paid 300 billion, so we should actually still get a refund of 200 billion.
Okay, so government debt is not like our debt, not like us as a household or us as a business, because we are not currency creators and the government is a currency creator. So when you're talking about government debt, what you're really talking about are bonds. And bonds are a form of, I would describe them alternatively as safe deposit accounts at the Bank of England. So if you have spare cash, if it's over £85,000 and you're looking for somewhere safe to keep your over £85,000, then a bank account at the Bank of England is ideal. So your bonds are essentially a safe place for you to stash your money if you have spare cash. So when you're talking about debt, if you looked at it in the sense of a household, then I can never create money. So I can be in debt in the currency of the country that I live in. But because the government is the currency provider, it's never really in debt in its own currency. It's really a misnomer. I regard that language as misleading.
Traditionally, government debt is seen as the money that a government borrows by selling bonds in the open market to British financial institutions or to foreigners. That's not the whole story, though. Governments can actually run their own overdraft. We have a thing called the Bank of England, which is the government's bank, which the government actually owns. And the Bank of England provides overdraft facilities. In other words, essentially, the government is borrowing from itself. So the whole issue of debt is much more complicated in where it comes from, which is why, again, the Growth Commission's primary obsession, built into its original remit, of looking at the deficit, the debt run up by the UK government, and how that might be allocated in part to an independent Scotland, and therefore seeing what is the basic thing we do to make this debt go away. That rather takes at face value where the debt comes from.
Growth is growth that is sustainable on a finite planet. So we know the damage that our economy has done to this planet, but can we create an economy that is perpetually growing, yet is somehow not doing damage to the planet while we do so? Or do they simply mean that the growth itself should be sustained indefinitely, and we should never, ever think about an economy that is not growing? There are movements like the Degrowth Society, which advocates that we should think about shrinking the economy to a degree, because we're having too much of an impact on the planet. Or even if we just move to a steady state economy where we're not growing, we're not shrinking, but we are truly living sustainably within our means with the resources that we have.
So in normal parlance, economic sustainability is about your access to and your ability to go on using real resources, physical resources, energy resources, human resources. We live in a global capitalist economy which values growth and promotes growth over everything, but growth is not sustainable ultimately because you run out of resources. I suspect, having been involved in the early discussions around the Growth Commission, that the sudden appearance of the word sustainable was added in as a bit of an afterthought to cover up the fact that the main trajectory of the Growth Commission is increased economic growth. In fact, the Growth Commission looks towards doubling Scottish economic growth post-independence and probably trebling it. Now, that's completely at odds with trying to deal with climate change and trying to deal with the sustainability of real physical resources.
Yes, there are different ways of measuring your economy and measuring your economics. So the thing about GDP is when you discover that the disaster that was the Exxon Valdez increased the GDP of the American economy, you realise that that's perhaps not necessarily always the measurement of economics that you want to look at. I'm going to show my bias here and talk about measurements of inequality. So, for example, if you look at the Gini coefficient or Human Development Index, you'll see them on any Wikipedia page, and they'll describe some conditions within a country. So if you look at the UK and make a comparison between Sweden, Denmark, Norway, and Iceland, you can see that all these countries around about us are actually doing much better with their Gini coefficient in correlation with the Human Development Index.
This measure of GDP has led to a paradigm in economics that is about chasing GDP growth almost at all costs. So trying to grow that really crude inaccurate number as much as possible for as long as possible. And that might lead you to an economy that is on paper bigger, but it doesn't say anything about the shape of that economy or how unequal that economy is, or even if it is improving the health and well-being and happiness and worthwhileness of the people within that.
Yeah, well, you get economic growth, and you get improvements in productivity to get that economic growth by applying two things: capital and labour. The Commission is very keen to get more labour, and there's a whole sections on how we need to increase immigration of labour, increase skilled labour from abroad. But there's also reference to how we up the capital intensivity, the amount of investment in plant and machinery in the economy. And it's perfectly true, and the report makes allusion to this, perfectly true, that one of the failures of the Scottish economy in the last couple of generations is to invest in advanced plant and machinery, so that we have a low capital intensivity, a low amount of capital per worker compared to similar more productive economies in Western Europe. Unfortunately, where the growth report thinks is going to get the extra capital to do this is through inward investment. That's debatable, but even if you wanted to go that route, you end up, having to cut taxes to persuade the big multinationals to come and invest in Scotland. So you're quickly going down a neoliberal model and a deregulated model, which I think is implicit in the Growth Commission. If we want to increase capital intensivity, if we want to actually increase investment in plant and machinery and technology, which we do post-independence, then we can do that from within our own resources. The Scottish Government has already created a National Investment Bank. I think that's a primary tool, and we should expand its remit so that we don't have to be dependent on foreign capital. We can do it ourselves.
Well, the Job Guarantee Scheme is a retort to a particularly nefarious concept in orthodox economics called the NAIRU, the non-accelerating inflationary rate of unemployment, which posits that it is necessary to keep a percentage of your population unemployed to hold inflation down. I find that particularly nefarious because of all the toxic societal effects that come with unemployment. It is not necessary to keep a percentage of your population unemployed. So at Modern Money Scotland, we are currently writing a paper. We're very close to publishing it, and it will be about the Job Guarantee Scheme. So the Job Guarantee Scheme aims to make the government the employer of last resort. So there is no such thing as involuntary unemployment in an independent Scotland with its own currency and own central bank.
It's a cash payment made to every resident in a country, regardless of their circumstances. And this is a complete paradigm shift away from the benefits system that the UK uses, where you have to fit into very specific circumstances to receive benefits, and trying to qualify for those can be quite onerous. It can involve quite a lot of processes to get there. And there's often a lot of pressure on the departments that manage these benefits to try and find reasons to refuse to give these payments. And it can be a very exclusionary process. A universal basic income, however, just gives the money to everyone, regardless of their circumstances, automatically. And if people are already earning, then maybe that money can be taxed back off of them. But this universal system, because it's already in place for everybody, regardless of their circumstances, when those circumstances change, such as maybe they lose their job because of a global pandemic, they still get these payments. They don't need to jump through hoops to get a pittance from a government that really doesn't want to give them anything.
What the Sustainable Growth Commission is suggesting is that Scotland should voluntarily agree to pay towards the UK national debt and the interest charges on the UK national debt, and also that instead of having our own overseas aid programme, we should carry on using the UK one, and therefore contribute about £1 billion or so per annum for the London government to disperse as it wishes. So I don't think there's any question about taking a share of the UK national debt. I think the whole question arises out of a misunderstanding of what the UK national debt actually is.
We absolutely don't need to pay a solidarity payment to the UK government. Why would we pay pounds to the UK government when the UK government can create pounds at will? Really, for a government and its currency, you can liken the currency to being like points. It can never run out of points. An umpire can never run out of points. So, the currency is essentially worthless in and of itself. So what probably would happen at the point where we are talking about dividing assets with the rest of the United Kingdom, we would be talking about real physical assets. So, and another thing to bear in mind as well, as far as economics, or the economics of Scotland and the economics of Scotland within the UK, is that at the Act of Union, we were 20% of the UK population. And now we are 8% of the population. And even if you just double our population just now and think about what that would mean in terms of our economy, you get the idea that policies that have encompassed Scotland through Westminster choices have really been detrimental to the Scottish economy, just from that very basic point of view of losing a very vital resource, which is people, the people of our country.
Okay, one of the big debating points will be how much is transferred in terms of assets and debts, and how much of the legacy UK debt will Scotland take on and be responsible for paying. And there's various ways you can calculate this, from simply walking away and letting the UK own all of the debt as the successor state to the previous country, to taking various proportional shares of that debt and then paying it off in the usual way. However, the Growth Commission takes a different approach. It has proposed an annual solidarity payment, which says that Scotland wouldn't be responsible for any of the UK's debt, but would pay the interest on that debt, pay a sum of £3 billion a year, indefinitely, to the UK to service that debt. And it would do this without being able to pay off that debt, if you want to put it that way. So it would be a perpetual payment until it was renegotiated. There would also be £1 billion a year for what they call shared services. So instead of Scotland, or until Scotland sets up its own departments, or its own civil service functions, it would simply pay the remaining UK to fulfil that role for it. And there was a further £1.3 billion a year, which represents Scotland's entire foreign aid budget, so which would be transferred to the UK to be spent on its foreign aid programmes. So under the Growth Commission plan, Scotland wouldn't have a foreign aid department. It would just give the money to the UK, and the UK would spend it. This, for my part, is a terrible idea. And we should be looking at the historical precedents for how things like assets and debts are split between countries when they split, and we should adopt the lessons that have been learned. So when the economies get into crisis, when businesses suddenly need an injection of money because maybe a global pandemic has happened or a financial crash has happened, they might go to their bank, their retail bank, to try and get that money. But if the bank itself is struggling, that bank needs to go somewhere else for that money. That could be another bank in a similar sector, another financial house. But if they are also in crisis, as we saw in 2008 when everything was collapsing, there needs to be someone at the top who can always guarantee that money. And in most countries that have an independent currency, that role is held by the country's central bank. Now, if you don't have your own currency, then the Monetary Institute, or whatever department you have that does a similar job, although much more limited, might be able to fulfill that function, but it might not. And this is one of the risks that not having your own currency might pose. It should be said that the lender of last resort, while a prominent political point, isn't the be-all and end-all of financial regulation. The regulations themselves to make sure that banks don't collapse are just as important, because if your banks don't collapse, you can't have a banking crisis. But also making sure that those regulations are followed through proper implementation of the regulations is important as well. If we have the economy set up so that it is resilient to shocks and crashes, then the need for a lender of last resort, while important to have, while useful to have when you do need it, the need to have it should be much less.
Every country has to have a lender of last resort. At least every country that has its own central bank and its own currency. And if there is a country with its own central bank and its own currency, the lender of last resort, the person who makes sure that there is money available to always make sure that the economy goes round, is that central bank, because they can always issue more of their own currency if there is, for example, a banking crisis, which we saw in the UK as a whole in 2008, and we saw again in March 2020, although that's been less widely publicised. So the lender of last resort is the central bank, if it has its own currency. Under the Scottish Growth Commission proposals, the idea is that there should be no central bank in Scotland with its own currency for some time to come. That means the lender of last resort, the only organisation that could bail out Scotland's economy if there was to be another financial crisis, would be the Bank of England. Why would the Bank of England want to bail out Scotland in that situation when it has no responsibility for its economy? I'm quite sure, and I am absolutely confident in saying, that the Bank of England would not want to bail out Scotland in that situation, meaning there would be no lender of last resort in Scotland under the Scottish Growth Commission proposals, in which case Scotland would be exposed to the most enormous financial risk, that if there was another financial crisis, there would be no one to keep its banking system working and a total collapse would be possible.